China to open key sectors to foreign investment, plus inflation in the United States reaches a three-year low as the Federal Reserve prepares to cut interest rates. Hello, I'm Anand Naidu, and this is The Heat. The World Bank says global growth is stabilizing, but at a weak pace. Here in the United States, the Federal Reserve is expected to lower interest rates next week. In China, foreign trade is up while producer prices are down. The country is also moving to open up manufacturing to foreign investment. So what does it all mean? We'll ask our panel. Liang is a chair professor in economics at Willamette University. Otaviano Canuto served as a vice president and executive director for the World Bank. He's currently a senior fellow at the Policy Center for the New South. Also with us is Gong. He's a professor at the University of International Business and Economics. And Anthony Chan is a former chief economist with JPMorgan Chase. Thank you, everyone, for being with us. Anthony, let me start with you. I will get to the Federal Reserve in just a moment, but let's look at some other key numbers. The consumer price index here in the United States, it increased by 0.2% in August. That puts the 12-month inflation rate at 2.5%. Then if we look at the employment numbers, employers added fewer workers in August than forecast. And looking at those baseline numbers, what does it tell you about the U.S. economy?
Well, Anand, I think it's telling you that there is a little bit of a slowdown in the overall economy, but it's still in a very good place. If you look at the Atlanta Federal Reserve nowcast model, which is one of the most accurate barometers of what's likely to happen in the next quarter, it's forecasting as of today economic growth in the third quarter of 2.5%, which, by the way, is basically the same growth that you got for all of last year. So the U.S. economy may be slowing from the prior quarter growth pace, but it's still in a very healthy place because potential growth, Anand, is 1.8% in the U.S. So we are growing above potential. And on the inflation front, it's great news because we're getting closer to the 2%. Remember, Anand, that the peak in the CPI was 9.1%. We're down to 2.5%. And that's simply because of the lagging component of the OER out there, the rent or the shelter component. If we were using a real number like Zillow or something to measure rents, then we would already be below the 2% inflation target.
Right, talking about those inflation rates, Anthony, the Federal Reserve is expected to cut interest rates. Speculation is that it will be 0.25%. What is your feeling on that? I mean, there's also been talk that it could be as high as 0.5%.
Well, I think that's the range, anywhere from 0.25% to 0.5%. My suspicion is that the Federal Reserve will just go 0.25%, because if they go 50 basis points, it could get the financial markets a little bit nervous. A little unknown secret fact is that historically, when the Federal Reserve has lowered rates for the first time by 50 basis points, the probability of a recession has been higher than when they've lowered interest rates by 25 basis points for the first time. I don't think this is a secret the Federal Reserve doesn't know. So it doesn't want to sort of provide that message to the financial markets that it's worried. So 25 basis points is the more likely. Ironically, a lot of the former Federal Reserve officials, even the prominent ones, are in fact talking about a 50 basis point, but the rhetoric coming out of the Feds sounds more like 25 basis points. So I'm going to go with 25 basis points.
Okay. Otaviano, I want to look at another figure, and that is global debt. It recently reached a milestone. If you add up the debt of all countries, it's it's $91 trillion, and 35 trillion of that comes from the United States. That's led the IMF to warn that this level of debt endangers the entire world. So explain how it endangers the world.
Yes, Anand, the fact is that, since the pandemic, we had an uptick, tremendous uptick on levels of debt. And on top of that, in the case of big advanced economies, the fiscal policy has been very proactive, very aggressively raising expenditures, associating that with the industrial policies. And this has led to a trajectory of a rising, not only primary deficits in these countries, but also the debt. when we talk about global debt, one has to keep in mind that this is an aggregate. You have different pictures. When it comes to, for instance, the low-income countries, then the issue is really a big one, because relative to the size of their GDPs and given the conditions of vulnerability that the economies face, some of this debt is unpayable. In fact, it is unsustainable. It is not the case yet of a country like the US. But the most important thing is to take the warning coming from these multilateral institutions about the fact that something will have to eventually be done to avoid a piling up of this debt.
You know, you say that for some countries, low-income countries, servicing this debt will be unsustainable. But here in the United States, I mean, payments on that debt is now going to get up to $1 trillion. I mean, some analysts and some who are not even analysts, people like Elon Musk, saying that's heading for bankruptcy. But the US can simply print money, can't they?
Now, the question is not simply a matter of printing the money. The fact is, what may create a huge problem is the perception abroad, if it takes place, of a potential default. Which is not the problem. The issue is not as of now a real danger. Mr. Musk is exaggerating in what he says, because while the rest of the world still wants to buy public debt by the U.S. as considered as a safe asset, there is way to go before there happens anything like this. So it's more, let's say, a warning about the trajectory of the debt relative to GDP if the pace remains the same one of the last few years.
You say a way to go. What would be one of the initial warning signs?
The creeping interest rates. If creditors start charging too much of a premium to buy long-term bonds of the U.S., then there's a signal that we do have a problem.
Okay, Liang, let's look at the situation in China. Well, China's exports rose more than expected in August, while imports missed expectations. Total trade with ASEAN member states was $63 billion. That's actually an increase of 10%. And the European Union and the United States remain China's second biggest and third biggest trading partners. China's trade surplus grew by 11% to $608 billion. What do you make of those numbers?
Right. Good to talk to you, Anand. So I think these numbers simply show that there's a very large external demand that helped to, in a way, supplement with China's internal demand. And that is a very good boost for the Chinese economy. So I think, for one, there's a debate about the insufficient internal demand in China. But I think, that problem, again, is in a way helped with this very strong export growth. Now, I think also that reflects the China's industrial, competitiveness, right? Because manufacturing output growth and also exports have been really strong, especially when you look at the exports of cars, integrated circuits, and some other industrial materials and equipment. All those are really strong that boost China's exports. And on the other hand, I think also it's interesting to know that ASEAN countries has remained the top trading partner, which again showcase that China is diversifying its external markets, and it has been really forming good partnerships with the global South. That said, I think China still has a way to go to help to implement more effective policies to boost its domestic demand. We know industrial output growth has been really strong in the first 7 months. Grew the industrial value added is 5.3% growth, but retail sales have in some ways lagged behind. So I think hopefully in the in the third and fourth quarter, we'll see more policies that help to increase domestic demand. And I think some of the policies have been talked about, such as allow households to refinancing their mortgages, some of the equipment trade-in, and also consumer goods trading policies. And I think all these would be super helpful to bolster the domestic demand as well.
Right, but on foreign demand, Liang, are the tariffs that we're seeing imposed making an impact?
Right. So obviously, we have seen this rising trade tensions and also protectionism in especially the United States and EU when it comes to EV and other green products, and some of the developing countries are also raising their tariffs. But again, I think China's products are simply so price competitive with the larger scale of development and production. I think China's exports will remain very competitive, and so I don't think this kinds of tariff hikes will really put a large damp on China's export growth.
Right, John Gong, there was a decision out of China's highest legislative body on Friday to start to increase the nation's statutory retirement age. The retirement age has not changed in China since the 1950s. Now it will be raised from 60 to 63, but it varies, 60 to 63 for men and 55 to 58 for women in white-collar jobs and 50 to 55 for women working in factories. Why these changes?
This is actually long overdue. I mean, if you look at the official retirement age in China for women, it's 55 years old, and for men, 60 years old. I think it's not in accordance with the practices in many industrialized countries. I think in the United States, the official age that you can claim social benefits I think it's going to 66 years old. We all know that people are a lot healthier these days. When you get to 60 years old, you're still in good shape and still be able to work. I think that's, the most important motivating factor. And another reason, obviously, it has to do with the long-term sustainability of the social benefits here in China, social security system here in China. If we're talking about working for about a year more, and claim these benefits a year later, the net effect on the social security system would be essentially postponing the time to claim these benefits 2 years later, and that helps with beefing up the social security system here. I think that's also a fairly strong financial reason. And regarding the economy, because the social security system also has a lot to do with the economy. It's being subsidized essentially by the central government budget by amount about 2 trillion yuan, 2 to 3 trillion yuan a year, and that's a fairly significant number in my view. I think the Chinese economy has to do well in order to sustain these payments. I think, frankly speaking, right now, we're facing some challenges here in China, especially the challenges associated with the local government's debt level. And in my view, China's economy has about a little bit short of 40% associated with government expenditures, public expenditures, and due to the debt level, the difficulties of meeting their fiscal expenditures at the local government level, there's a contraction essentially on government expenditures at the local government level, and that obviously going to be reflected in the growth figure. And also associated with private consumption as a result of the contractual practices at local governments, and I think that has to change.
Right.
In a time of difficulties like this, we need to adopt a counter-cyclical measure, as opposed to let the government to contract at the local government levels.
Right. Okay. You want to say something, Otaviano?
Just that the challenge of aging. It is not unique to China, on the contrary. And in all societies where aging has been taking place, accompanied by higher levels of longevity and higher health of people, naturally you have to extend the time of useful life to avoid a disaster on pensions, and also the impact on productivity in society and so on. So the motivations for doing so are the same ones that also have been behind movements like those in Europe, eventually here, and in emerging markets, even Brazil. Brazil is aging fast, for instance.
Certainly not unique to China. Anthony Chan, getting back to the United States and looking at manufacturing. Manufacturing here in the United States shrank in August, and that's for the 5th month. In fact, employment at factories also shrank. What does this tell us about the strength or resilience of the manufacturing sector?
Well, I think it's one of the most cyclical sectors in the U.S. economy. That's well known. And if the economy is going to be slowing down, you're going to start to see that effect on the manufacturing front. But remember that there is a lot of stimulus still in the pipeline that's going to support the manufacturing sector, the CHIPS Act, and things like that. So, yeah, you're going to see this temporary slowdown in manufacturing, but that's just temporary. I think when the stimulus kicks in, the manufacturing will get a boost later on. So I'm not worried about that slowdown because the rest of the economy is still doing well. Consumer spending in the 3rd quarter is still expected to be close to 3%. And remember, that's 2/3 of the economy. So if 2/3 of the economy is growing at 3%, I don't think there's a real reason for concern. And again, the manufacturing sector is about 20% or less of the overall economy. So it's not a real concern, just like the housing sector, residential housing. It was starting to recover, and now it seems to be slipping back again. But residential housing is only 4% of the economy, and if the Federal Reserve starts lowering interest rates, the residential housing sector is going to rebound. The other interest-sensitive sectors like autos will rebound. So things will, in fact, start to see some improvement moving forward.
Right, Liang, and looking at the manufacturing sector in China, well, China has just announced that it will open that sector to foreign investments, and also at the same time it will allow more foreign capital to be injected into the health sector. The biotechnology sector will also be opened up, and foreign companies now will be able to run medical services, hospitals, for instance, in some cities in China. What does this mean?
Right. So I think it means a couple of things. First of all, I think the symbolic value is very important. I think this really shows, and signals to the rest of the world that China is open for business. So the last time when this so-called FDI negative list was published in 2021 and enacted in 2022, and so there are actually 2 sectors in manufacturing that are restricted. So now there's a complete opening in the manufacturing sector for foreign direct investment. And I think at this stage, China is really aiming to introduce foreign competition and also to stimulate more innovation and technological, know-how and cooperation into China. So I think that is really the goal. Now, when it comes to service sector, it used to be much more closed to the rest of the world. But I think, at this point, it is important, again, for China to open those sectors to boost its competitiveness, productivity, and also cooperation and collaboration with the foreign investment and also foreign technological know-how and their, various important, organizational skills and so on and so forth. So I think that on the one hand shows, this is a time for China to upgrade its economy, introduce competition to bolster that kind of productivity growth. And on the other hand, I think it really shows that China is open for business. China wants to integrate itself to the rest of the world amidst this really rising protectionism and sort of nationalism sentiment and that deglobalization trend in the world.
Otaviano, major central banks are now reducing interest rates, and a lot of that has to do with in anticipation of the Federal Reserve reducing interest rates as well. We look at the European Central Bank; it cut rates by 0.25% to 3.5. And given the direction in which interest rates are moving right now, would it be fair to assume that the chances or the possibility of a recession are now receding?
Yes, I would say the following. The likelihood of a soft landing really has increased dramatically. And look at the labor market here in the U.S. There are clear signs that it's cooling, but nonetheless, see, the unemployment rate remained at reasonable levels, wages kept rising. And it looks like when you combine the signals from the labor market with the decline of inflation, not yet at the 2%, but as was aptly observed already, moving towards the targets of the Fed. And 2.5% for this year is not bad. We are clearly on the eve of a synchronized process of easing. Even the Fed might have as we could read in the minutes of the meeting of the Open Market Committee, could have done already the start of the easing in the last meeting. That's why I also guess Anthony's bet on quarter point next week.
Yeah.
But the fact is that the markets have already priced in, have raised the likelihood of a cut to be of 50 basis points to 43% of probability, whereas last week it was in 15%. That is to say, the bet by the markets is still, on the 25 basis points, but the likelihood of a 50 basis points is there. And so we have this synchronization. In Europe, we have a mixed picture, as we know. Yeah. Germany is entering into recession. Spain is quite well. But I guess, as the headline that you have pointed out since the beginning, the world is kind of stabilizing at a growth path, as my former World Bank colleagues have aptly said, that is low as compared to the previous one of the last decade, but it's still 2.5%. So we are moving down from 3%, the global growth of last decade, to a new path around 2.5% over the next few years, which is not disastrous.
Right. John Gong, I want to talk about consumer prices in China, but before I get to that, what are your thoughts on what we were talking about a moment ago on China opening its manufacturing sector to foreign investment?
What happens is that China used to adopt a practice of publishing a list of industries being open to the foreign direct investment, and over time that has transitioned towards a practice called now a negative list. What it means is that it publishes a list of industries that are not allowed for foreign direct investment, and that list has been keep shrinking. And I think the opening up the entire manufacturing sector happened actually some time ago. I think they just re-emphasized this again. So what it means is that any industry within the manufacturing sector is entirely open. There's no restriction at all, right?
Right.
And I think I totally agree with Professor Liang that it means that China is open for business. But I think also what it says is that the confidence that for the manufacturing here in China, that everything is practically very competitive.
Okay.
And there's nothing to be protected, essentially, nothing to be protected.
Yeah. John, I want to talk very briefly about consumer prices in China. Prices edged higher in August due to extreme weather conditions, and the consumer price index rose 0.6 of a point in August. And China's producer price index went down 1.8%. What does that tell us about domestic demand in China?
Yeah, well, I think there's no doubt that consumer demand is kind of a weak, I think, reflecting a low price level. And I don't have official statistics, but I do have a theory about it. I think there might be something structurally going on that's actually not being captured by the statistics. That has to do with the extremely efficient and very price competitive electronic commerce activities. If you look at the statistics, companies like Pinduoduo and Alibaba and also JD.com, they've been increasing retail sales, entire retail sales very, very rapidly. And the prices are extremely competitive, especially associated with Pinduoduo. You look at the low price, look at the incredibly good values associated with these purchases. So what I surmise is that if you look at the expenditures, it's not increasing. But if you look at the things people are buying, not necessarily people are not buying things. They're actually buying things, other than they're buying things at a very good price.
Right.
And it's kind of difficult to be captured by the statistics, I guess. But this is what I suspect is happening, or at least partly happening.
Okay.
Explaining the weak demand in China.
Okay, Anthony, we are rapidly running out of time, but I want to get to a political question. Of course, we're in the middle of election season right now here in the United States. What do we know about the respective economic policies of the two candidates running for president? I mean, are they radically different, especially on issues like combating inflation, taxes, cutting spending?
Well, of course, because if you look at nonpartisan estimates, we see that if you elect somebody like former President Trump, the deficit over the next 10 years, according to the Wharton Penn model, is going to be more than 4 times what the deficit will be under a Vice President Harris if she were to be elected. And by the way, those numbers are assuming that everything that the fiscal policies of both get enacted successfully. But the reality is that because you have a polarized Congress, it's more likely that you will get only a small fraction of Harris's program. So the differences are even greater with regard to the fiscal policies of both of them. So they are, to some extent, different. Bottom line, inflation will be higher under a President Trump administration, and it won't go up as much under a Harris administration.
Okay.
Trade. Please highlight as well the difference between the two candidates with respect to trade. In a very simplistic way, while, let's say, Kamala Harris carries the approach by the Democrats, which is more like de-risking, the approach suggested by Mr. Trump is decoupling.
Yes.
And if he follows through with the promise, he's elected and follows through with his promise, that's going to be a disaster for the U.S. and for the global economy.
Okay, I want to get Yan Liang's opinion on this very quickly. Yan Liang, of course, China would be looking very closely at this election in terms of trade policy. Do you expect much to change?
Not at all. I think, during the debate, Trump also mentioned this to Harris, that her administration, Biden's administration basically inherited his tariff hikes, and that has not changed during the Biden administration. And I agree that there is a finite difference between de-risking and decoupling, except that we're seeing that de-risking is expanding, right? The high fence and small yards gradually becomes high fence and broad yards. So I don't see much of difference, because I think now this anti-China, anti-trade kind of free trade kind of policies has been really a bipartisan consensus.
Okay, that is where we have to leave it. Thank you to all of you for being with us. That's it for this edition of The Heat. I'm Anand Naidu in Washington, D.C.